Hi, I'm Matthew Lester from the Rhodes Business School in Grahamstown. Young professionals starting off a career often ask the question, what is the difference between saving, investment, speculating, and gambling? And they need to really look at four key investment topics. They need to be able to differentiate between investment, saving, trading, speculating, gambling, etc. They need to look at the significance in financial terms of the different fields of investment. They need to understand investment goals and the associated time horizons. And they need to understand asset allocations and discuss the most appropriate assets to develop a portfolio over a period of time. It all starts off with understanding risk. Set up a time horizon and put up two goalposts. On the left goalpost, you put zero risk, and on the right goalpost, you put insane risk, which you obviously wouldn't take. And then you fill in the time horizon. Savings have very, very little risk. You put your money in the bank account and you get a return. Investment takes on a little bit of risk, but one has to look at higher rewards. Then speculating is an even higher risk, and then finally insane risk is gambling. The higher the risk, the higher the expected return. So saving in a bank account, the return will be 3 to 6% per annum. If you're investing, you can expect a return of between 8 and 12% per annum. Speculating, you might get a return between 12 and 20% per annum. And gambling, you will get an infinite return based on an insane risk. Now, why don't we just save? Why is it necessary to take on any risk at all? Let's demonstrate the concept. Take 100 Rand 3 years ago and grow it with the inflation rate, the stock exchange rates, and a savings account. With inflation, 100 Rand would today be about close to 120 Rand. But if your money had been in a bank account and you'd paid tax on the interest, your returns would be below the value that you would need to cover inflation. Thus, we have to look at having higher returns by taking on a little bit of risk and looking at investment. Thus, we have to take on higher risk in the expectation of higher returns, but we have to be able to manage that risk. It's very important because if one takes 100 Rand and grows it with inflation over 3 years, 100 Rand becomes nearly 120 Rand, and investment returns on savings accounts are simply not going to cover that sort of growth in inflation rates. This, of course, is the overall consumer price index. There are even more frightening factors. For example, your earnings will grow faster than inflation. When one looks at other commodities, such as fuel, 100 Rands worth of fuel bought 3 years ago would not cost 120 Rand today. It would cost closer to 180 Rand. And one's all heard of the electricity crisis. 100 Rands of electricity 3 years ago wouldn't cost you 120 or so Rand today. It would cost you nearly 185. The end result over a 3-year period is that investments growing with the inflation rate will not be sufficient to cover some of the costs that are expected for the future. Why are interest rates so low? Well, the head of the Reserve Bank, Jill Marcus, her job is to contain the interest rate. She has to basically pander to the drum of the Minister of Finance, Pravin Gordhan, who says, I need low interest rates to drive the South African economy. There is little prospect of interest rates increasing in the short, medium, or long term. So the moral to the story so far is, it's going to take you more than a lifetime to get rich earning interest. You can even get poorer leaving your money in a bank account. Is there any place for saving in South Africa today? Yes. You do need a savings account. You need to build up money to finance deposits on a house or a car, for state occasions such as a marriage or a baby, or for all events that fall outside your monthly budget where you need to have some form of war chest. So yes, we have savings. They do have a place, but you're not going to get rich on them. So we have to take on a bit of risk. And this is where we start looking at investment, speculating, and gambling. And that we will do in part 2 of this series.